rallies are still around. Ron Spector.
I bet we're going to be hearing her sing here momentarily. That's it for this abbreviated day on Wall Street. Merry Christmas, everybody. Second hour of the closing bell coming up now with Kelly Evans.
Hello and welcome to a special edition of the Closing Bell on this Christmas Eve. Darlene Love may actually help us ring it in here in a couple of minutes. I'm Kelly Evans. Santa Claus delivering another record close on Wall Street along with some gifts tonight. Here's how we're finishing the day. Take a look at the major indexes. The Dow's up about 64 points. That's about a third of 1%. The NASDAQ up about a tenth of a percent. The S&P 500 adding 5 points, 1833. I believe we're talking about fresh record closes there for the Dow, the S&P, the NASDAQ, of course, off its all-time high still. And as we said, record highs in the markets. Just want to have my panel with me. Introduce them. First of all, Dan Greenhouse from BTIG. Kate Kelly is here. Sharon Epperson and Andrew Stoltmann from Stoltmann Law Offices. Brian Kelly with us as well. So we've got the Kelly, the core group of Kellys on this Christmas Eve.
I am hearing some excitement that's sort of pent up about emerging markets. The feeling that they're way beaten down, and this might be a chance to look at some fundamentals and pick your spots.
Dan, what do you think? Are emerging markets dead money here? Or is there time to look at the opportunity and say they're trading at such a discount to some of the more developed markets that these are the guys that are going to rally?
Well, let me start by saying that this is a trade that we got wrong in the fourth quarter. Historically, the seasonality favored emerging markets over U.S. equities. That indeed has obviously not been the case. Going into next year and emerging markets in general, I think it's important to distinguish between the various markets in the emerging markets. You have obviously Latin America, you have emerging Asia, you have countries such as India, which are experiencing different idiosyncratic issues as compared to something like Brazil.
Right, and one thing you need to look at is currency support, right? I mean, are they going to be able to maintain the value of their currency, among other things?
Right. Are these going to be nominal rallies in the markets that we're seeing, or real ones? Because people can get wiped out if they're not hedged for the currency.
Well,
and is it fair to sort of use, Andrew, sorry, the fragile five, the bits? This seems to be the new phrase everyone's talking about. But go ahead, Andrew.
Well, yeah, Kelly, I was just going to say, emerging markets are about the only area of the market right now that really hasn't raced up in this past year. And I certainly don't mean to be the Grinch who stole Christmas, but I just think a lot of this activity really has to do with window dressing on the market. I'm not reading too much into what happens today, the last couple of days, or even the next couple of days. But I love emerging markets. I think it's one of the few areas where you can get some risk-adjusted return.
Can I, though, just jump in here? I got to ask Mr. Brian Kelly, what is going on with Twitter? $70 a share today.
It's insane. It's just gone crazy. I mean, the one thing about Twitter, it's similar to LinkedIn, where their users can monetize their experience. So you see a lot of people advertising, a lot of people being able to get out there and sell whatever they have to sell, which is the same thing with LinkedIn, although LinkedIn actually has that kind of built-in pro element to it where you have that monthly subscription. But in environments like this, when you get frothy stock markets, you always get these hot stocks, and Twitter seems to be the one that's just gone crazy.
Yeah, I mean, we're talking about 8%, 7% rallies in just the last couple of days.
The fundamentals of Twitter. I mean, the company isn't making much in the way of money. I mean, its growth is kind of slowing down in some of the foreign markets. So I just don't understand what the Twitter pitch is. But look, the stock price disagrees with me. Obviously, it's racing up.
Brian, I just want to jump in here and say, with respect to the 99 comparisons, it's very important to remember that for a lot of these companies, like Facebook, like LinkedIn, like Twitter, they have either revenues or earnings or the immediate expectation of revenues and earnings. In 99, you had a number of companies that had no expectations of earnings power.
I don't know.
No doubt. But the point is,
it just seems to me that earnings should drive stock prices, and companies that don't have their earnings, like Twitter, should be really troubling to a lot of investors. But that hasn't apparently stopped people from getting into it.
Hey, Andrew, are you on Twitter?
I am on Twitter.
Do you tweet often?
All the time.
Have you ever clicked on a sponsored tweet?
Not once. That's why I can't figure out their business model.
All right, we'll see if they can win us over.
And Scrooge's name was good on the London Exchange for anything he chose to put his hand to. Ah, Mr. Scrooge. Your servant, sir.
Well, despite Andrew Stoltmann, not a ton of Scrooges actually around the exchange this afternoon. Coming up, the record rallies of this year are set to boost Wall Street bonuses. Our panel will weigh in on whether this is a good thing or humbug. Stay with us.
There is just one thing I need. I don't care about the presents underneath the Christmas tree.
Welcome back. 2013 turned out to be a pretty big year for markets, and the Wall Street Journal reporting the recent rallies have saved bonuses for many on Wall Street. Tough capital rules and new restrictions on the amount of trading banks can do with their own money have affected bond traders. But the Journal reporting many big banks also grappling with how much to pay out to traders, deal makers, and others. So will the only green many Wall Streeters see this Christmas season be a Christmas tree? Let's turn to the panel and get some thoughts here. Andrew Stoltmann, starting with you. I mean, what do you glean here? We've talked about the weakness, for example, mergers and acquisitions, but the IPO market's been strong. So who's going to get the bonuses this year?
You know, look, it'll probably be the IPO guys and the traders on the equity side, but I just have a problem with the compensation structure. You know, it's funny, when times are good, like they were this past year, or this year, I should say, Wall Street executives, Wall Street employees demand outsized, massive, large bonuses. But yet when times are bad, like 2008, they come to the taxpayer, hat in hand, and say, gee, we need an $800 billion bailout. You know, when you're gambling with other people's money, when times are good, you want your big share, but when times are bad, you basically say, taxpayer,
Kate, are you surprised the
out.
comp model hasn't changed more? I mean, why is it that it's still this bonus structure?
Well, I think it's important as an incentive to keep people performing well. I think that would be the bank's argument, although they have in recent years shifted much of the compensation from cash and into stock. So people really are kind of have to be committed to working at their companies for 3 and 4 years because they get so many restricted stocks or options on their own company stock that vest over a period of time, and they keep replenishing. And if they leave, unless someone buys them out, which is increasingly unlikely in this environment, they have to leave a lot of money on the table. But having said that, you know, I spoke to a couple of people within the last few weeks at different banks saying, what do bonuses look like? And therefore, I'm dubious about this Wall Street Journal report because they
what
said,
are you
look,
hearing?
Well, they're saying bonuses are going to be modestly up this year, but in terms of the comparison between a P&L, you know, the profit and loss on a given desk, and the bonus percentage, there's going to be a gap. You're not going to see a 20% bonus of your P&L, even if you're up 20%. It's going to be much more modest than that, and I think that hasn't changed.
Well, where I am talking to commodities traders, many of them are saying they're having the worst year they've ever had. So the idea that they're going to get any type of bonus, but I know who's crying for them. But there's, you know, when you compare to what some of these equity traders may potentially be getting, you're not seeing the same in the bond market or for commodities traders. So it's been a rough year for many of them.
I think equities are definitely better off. I mean, you've seen the closure of a number of commodity hedge funds, Sharon, right? Yep. It definitely has been tough there, and so equities I think will be relatively better. But I think in general we're going to see modest up performance.
Do we ask Dan how big your bonus is?
I got to jump in here for a second.
That's a real question.
As someone, the only one on the panel eligible for one of these bonuses that we're talking about, I want to say 2 quick things. The first is, Andrew, with all due respect, I think it's disgusting that you would say boo-hoo to an entire group of people down here who come to work every single day and are having a really tough year and are likely not to be compensated in the manner in which they've been compensated in the past. They're having a tough year, and I understand that you think they're rich
better than 95% of the people out there. They have no reason to complain. They're part of the problem.
That bonus for a lot of these people is all they get, and if they get nothing, then they get
down the global worldwide economy. When you do that, when you do what they did in 2008, now I know all the employees today weren't the same ones in 2008.
On the floor did anything in 2008. Right. None of them.
Sure.
And second of all, let me add, you talk about the big banks. 90% of those big banks didn't want the money. They took the money, and the restrictions that came with it were imposed after. That's not fair.
Here's a novel concept. If you're a J.P. Morgan employee and your firm has paid out tens of billions of dollars because they've defrauded so many consumers and customers over the years, you forfeit the right to bitch and complain about not getting a bonus. Guess what? You can't do it anymore because your firm is a major reason why we're still in this economic malaise.
So all of J.P. Morgan is tainted. Because I got news for you, Andrew. There's a couple of shady people in the lawyer industry as well.
Sure.
Does that mean that your compensation should be down?
No. But if there's shady guys in my law firm, you better believe I'm not entitled to a bonus. If I'm employing guys who are taking unethical behavior, guess what? I don't get a bonus. Although technically I would since it's my firm. But what I'm saying is if you're a J.P. Morgan employer, you forfeited the right to complain at this point. Sorry.
Kelly, I think the fact that these guys are having this debate, this spirited debate, is a reason why the structure has changed, why we're seeing more company stock or options compensation, why we're seeing less cash, why the numbers are going to be down overall. I mean, I think all of this is part of what's taken into account.
And by the way,
when Wall Street
there's an interesting development. A lot of this again happening in the UK and across Europe, but the clawbacks of bonuses and of comp generally are becoming a more common phenomenon. And we're talking about periods of, say, 10 years. Andrew, I wonder, in that would more aggressive clawbacks take care of the issue about specific individual wrongdoing as opposed to saying to any member or anyone working at a bank that's ever been bailed out by the government, for example, that they are no longer eligible for typical compensation?
That's a real good point. I mean, the clawback is a crucial piece that can be used to get back money that should go back to the to the company. And I'm a big fan of it. Now, I've heard a lot spoken about clawbacks, but I haven't seen a lot of money being actually clawed back. So yeah, if we can identify the employees, absolutely claw that money back.
No, and to Dan's point, though, to some extent, you can't really claw back a house. I mean, how do you can go? I mean, to what extent are you going after money that's been converted?
That's why you have the restricted stock.
Andrew, here's the thing that's very interesting about what both of you are saying, and you have to keep in mind that these are people that are, many of them, used to trading on margin, on the edge. And that means what I'm finding as a personal finance correspondent as well, they're also living on the edge. So these bonuses are very important to them. And when they're having a bad year, if they haven't kind of recalculated what their personal lives need to be, just as they've recalculated what they're going to potentially be making in the market, they're in trouble. So while you're saying, you don't want to cry for them, but listen, but it is a serious situation. It's just at a different level than that many other people in this country are experiencing, but they're experiencing the same thing. Granted, at a far different scale, but it's the same kind of issues. I'm hearing it time and again. They can't afford their homes either. It's just like middle America.
Be responsible with your money. I mean, if you're living above your edge, that doesn't mean, well, gee, I don't have to give this money back if we do something wrong. That's why I'm a big fan of the restricted stock. Make it a 5-10-year period, and then if you do screw up or your department screws up, you take that money back. And if you can't live within your means, that's on you.
I don't know if I would compare it to middle America, Sharon, only because, the average American is making $50,000.
No,
and the average person you're talking about makes far
I understand
more.
that, but what I'm saying is not having the bonus, at least where I'm covering in the commodities market, where many of those people are just happy if they can make near what they made last year, then that they are suffering. Some of them in their own way, they are suffering.
And let me make a quick analogy here to bring this to something we can all relate to. In the Christmas vacation, when Clark Griswold got the Jelly of the Month Club for his Christmas bonus, he still lived in a nice house. He still had a wonderful family. He looks like he's plenty of money, but we were still sympathetic that he got the Jelly of the Month Club. I don't think it's fair to yell at the commodities traders for getting the Jelly of the Month Club.
All right, we got to go.
Live within your means.
Wow, what a year it has been for Marissa Meyer. Just want to get some thoughts from the panel here. And to John's last point, what's happening with Yahoo Mail is potentially a big problem for them. We still get tweets about it. People write in to the show all the time complaining about how poor the user experience is. They've still lost some old emails from the past. And this is, Kate, part of her strategy is to really focus on these core products and deliver on them. They cannot falter now.
No, I think that's absolutely right, Kelly. And actually, I think John Ford had it quite right when he said she's someone to watch because she's been set up to such a high pedestal, the stock performance, among other things, that this could be the year that we see more stumbles. There's really a lot of heat on her. There was a good story in Vanity Fair recently making some of these same points, saying that one of Marissa Meyer's best skills is managing her image and sort of neutralizing critics.
As opposed to managing people.
Exactly. And that some people believe she has an imperial style. She had a lot of detractors at Google.
And it kind of reminds me of the old Wendy's commercial. I mean, where's the beef? I mean, we know that she's the rock star. We know that the press is in love with her. We know that shareholders are in love with her. But if you look at the actual results of her company, and if you peel the onion one layer, it really isn't all that impressive. It was referenced earlier that the Alibaba has absolutely taken off in China with Yahoo's 24% interest. Yahoo Japan is off the charts. I mean, so far she hasn't been able to deliver what she needs to deliver, which is growth in the core areas. So there's nothing sexist about criticizing her. It's just the opposite. Everyone's
more just about like those elements of the criticism. But Dan.
Well, the top brands in the world have the most value, particularly the top three this year were Domaine de la Romanée-Conti, Chateau Lafite, Rothschild, and Chateau Petrus.
Is that in terms of demand or price point?
Value, yeah, demand and value in dollars achieved. I mean, those three brands represent about 25% of the market.
Wow. I guess we know what to get for a holiday gift if you've got a couple of minutes left. And just curious, wine as an investment, do you recommend it?
Oh, absolutely. I mean, it's been proven to be one of the great investments over the last 25 years. I mean, there are wines that have gone up in value 40% over the last year alone. And
sounds like the market.
Yeah, it sounds like the market. And some wine stocks have gone up considerably as well. Why invest in wine and not the equities, or do both? How do you determine?
Well, I think a little portfolio diversification appeals to a lot of investors. They don't want to have all their grapes in one basket, and wine is a really stable asset. I mean, it's very good for long-term growth as well. There's always pressure on demand because people drink it. And so supply is going down, and people are going to want the same amount of wines, but people are drinking it, so there's less and less and less.
Andrew, did you want to jump in here?
Yeah, you know, Kelly, I think maybe Wall Street could really begin to like this idea. Maybe they can securitize these things, do no due diligence on them, and then jam them down the throats of unsuspecting investors. I think that might whet
like
Wall Street's appetite.
Investors are not all unsuspecting, Andrew. Some of them are suspecting.
Slate financing, it works with mortgages, it works in Hollywood.
Sure.
I mean, it's
Why
a
not
great
wine?